Welcome to the Deep Dive. Today we're jumping into the recent first quarter 2025 financial results call for Veritone Inc.
Yeah, we're going to break down the transcript, pull out the key stuff, and try to make sense of, what actually happened and what might be coming next.
Okay, let's get straight to it then. Looking at the top line for Q1, Veritone reported revenue of, $22.5 million.
That's right, $22.5 million, which was actually down $1.7 million compared to Q1 last year. Now, it was in line with the preliminary numbers they put out, but yeah, just a bit below their own guidance range.
Okay, so a slight miss against guidance. What did they say caused that?
Mostly timing, apparently. Delays on some larger public sector deals they thought would close in the quarter.
The usual timing issues.
Exactly. But they did get a nice boost from their new Veritone Data Refinery business, VDR. Yeah. That helped offset it somewhat.
Well, okay, let's break down the segments real quick. Managed services revenue came in at $8 million.
Yeah, $8 million. And that was down about $109 million year over year. They said that was mainly, declines in representation services campaigns, and they kind of expect that headwind to stick around through 2025 unless the macro picture improves.
Right.
And there was also a slight dip in licensing revenue within that segment, too.
And how about the software side of things?
So software products and services, commercial enterprise revenue there was down by $0.6 million compared to last year.
Okay.
Main things were lower consumption-based revenue from existing customers and also some negative impact from foreign exchange rates.
This is where VDR stepped in, right?
Exactly, yeah. That new VDR business gave them a pretty significant offset, contributed about $0.9 million in revenue in Q1.
Wow, that's pretty impressive considering it only really launched commercially late last year, Q4 24.
Definitely. It shows it's gaining some traction quickly.
And public sector, how did that fare?
Public sector saw a small dip year over year. They did point out it looks slightly better if you exclude some non-recurring project revenue from Q1 last year. So it kind of implies the core public sector business was holding relatively steady, but, those big deals they were banking on just didn't land in Q1.
Understood. Moving beyond revenue, what about ARR? Annual recurring revenue, always a key metric.
Right. ARR stood at $58.7 million, relatively flat compared to the end of last year, Q4 24.
But down year over year.
Yeah, down year over year, which they said was expected, mainly because of that anticipated step down in consumption revenue from certain commercial enterprise customers over the last 12 months.
But it's interesting, you see that shift underneath, right? So subscription-based ARR, that held relatively flat year over year.
It did, and it's now a much bigger slice of the pie. Makes up 81% of total ARR now, compared to just 68% back in Q1 24.
That's a positive shift, moving toward more predictable revenue.
Absolutely. Better quality revenue mix, even if the total dipped a bit. And on the new business side, things look pretty good. Total new bookings were strong, $15.8 million.
Okay.
That's up $2.9 million, or 22% year over year, primarily driven by larger software renewals, they said.
Good to see retention holding up, too. Gross revenue retention still above 90%. Customer count, though, that ticked down slightly.
Yeah, total software customers were 3,156, down 7% from last year.
Mostly commercial.
Predominantly, yeah. Reflects those lower consumption customers and also, sunsetting some legacy customers from the Broadbeam acquisition. But it was partly offset by some growth in public sector customers.
Okay, let's talk margins. Profitability. GAAP gross profit was $13.9 million, a 61.9% margin, down from 68.8% last year?
Correct. And the non-GAAP gross margin also saw a decline, came in at 65.1% versus 71.2% a year ago.
And the reason for that squeeze?
Main drivers were, less of that high margin consumption revenue and then a higher mix of lower margin streams in Q1, like VDR, for instance. Its margins were around 40% in the quarter.
Okay. Are those VDR margins expected to stay around that 40% mark?
No, they expect improvement there. Management sees them starting kind of similar, but expanding through 2025. As they add more types of content and, streamline the operations, the target, they said, is potentially reaching 70% plus margins in VDR once it scales up in 2026.
Okay, ambitious. Looking further down, operating loss actually showed some improvement.
It did, yeah. Improved by $2.7 million year over year, landing at $21.6 million.
And that's mostly cost savings.
Largely, yes. Lower operating expenses, thanks to the restructuring they did back in Q1 24, that helped offset the hit from the lower gross profit this quarter.
And the net loss from continuing ops, That improved even more.
Yeah, quite a bit more. Down $6.3 million year over year to $19.9 million. Helped by the lower operating loss, but also, interestingly, a $3.7 million benefit from a change in the fair value of an earnout related to an earlier divestiture.
Right. Now, the non-GAAP net loss was $11.1 million for Q1. How's that stack up against Q4?
It was a bit higher than the $10.3 million non-GAAP loss in Q4.
Why is that?
Primarily due to the lower non-GAAP gross profit in Q1. Even with the help from lower operating expenses, the gross profit dip pushed the non-GAAP net loss up sequentially.
Okay, so summing up the numbers, some pressure, as expected maybe, from legacy stuff declining, hitting revenue and margins. But you also see these early signs of growth in new areas like VDR, plus strong bookings. Management seems quite focused on that strategic pivot, didn't they, despite the Q1 timing hiccup?
Oh, absolutely. That was the main theme.
Yeah.
They highlighted securing over 100 new business and renewal software deals in Q1. So sales activity is still happening.
Right.
They acknowledged the tricky market dynamics in some spots, but definitely conveyed confidence in the progress on their big growth plans.
Let's dig into those key strategic areas then. Media and entertainment, AIware, VDR. They mentioned surging content demand.
Yeah, I mean, even with economic uncertainty, the need for content is just huge. And media companies need efficiency, right? That's where Veritone's AI tools like AIware come in, automating workflows.
They mentioned the Masters tournament as an example.
They did. Augusta National. Sounds like a massive project.
What exactly did they do there?
Managed over 200 terabytes of media. Think like 90,000 video files, 18,000 images, using their platform to process it all, manage it, get it distributed.
So faster access, better fan experience.
Exactly. Critical for a huge global event like the Masters. Helps strengthen the brand too.
So AI is becoming kind of essential for these media giants just to handle their libraries and actually make money from them.
Pretty much helps them push content out everywhere and get more value from those assets. And then there's the other side of the AI coin.
Training data.
Right. All these huge foundational AI models need tons of high quality training data. And there's a real shortage, especially of, clean, unstructured audio and video.
Which loops us right back to the Veritone Data Refinery, VDR.
Precisely. VDR is aimed squarely at that need. They mentioned the global training data market could grow from maybe $2.4 billion last year to over $17 billion by 2032. That's huge.
And Veritone feels well positioned because of their history.
Yeah, I mean, they processed almost 11 petabytes and nearly 60 million hours of media just last year. So they have the infrastructure and experience to source and, importantly, refine this kind of data.
And VDR seems to be picking up steam really fast.
It really looks like it. Management said their qualified near-term VDR pipeline is now over $10 million.
Over $10 million. Didn't they just say $5 million a few weeks ago?
Exactly, doubled in just a few weeks. And they stress it's not just one big fish. It's growth from multiple contracts, new partners, new clients, including hyperscalers and AI model developers.
Wow, doubling the pipeline that fast is definitely eye-catching. What kind of growth are they aiming for with VDR long-term?
The target CAGR, compound annual growth rate, is over 300% for VDR between 2024 and 2027.
300% AGR.
Yeah. And they've already delivered the equivalent of over 200 billion tokens from premium audio-video data to multiple clients for training purposes.
Okay, and back to those margins, around 40% now. How confident are they about getting those up towards that 70% plus goal?
They sound pretty confident. They see the initial margins, around 40%, but expect significant expansion through this year as they add more types of content and just get better operationally. The scale in 2026 is when they think they can hit that 70% plus range.
What are the key milestones we should watch for? Things that prove VDR is really working beyond just pipeline figures.
Good question. They mentioned a few. First, closing deals using new data sets, not just their existing stuff. Second, being able to play on both sides representing the buyers, like hyperscalers needing data, and the sellers, the IP owners. That dual role gives them leverage.
Interesting.
And third, a big one they said they're very close to is proving they can sell the same data set to multiple buyers. That really unlocks the revenue potential per asset.
Right, maximizes the value.
Exactly. And they're also looking beyond just media data, security data, public service data, bringing that into VDR too, which links nicely to another growth area.
Is there a sort of halo effect? Does VDR success help other parts of the business?
Management thinks so. They use that exact term, halo effect. Said VDR's buzz is leading to talks with dozens of new IP owners, and that potentially could speed up their core AI and digital media hub software licensing too. Just gets their name in front of new potential customers.
Okay, let's switch over to Veritone Hire. Tough labor market, obviously, but they're focused on mid to long-term growth.
Yeah, their approach there is kind of three-pronged. 1, expand the reseller network. 2, improve integrations with applicant tracking systems, ATS. And 3, grow their media services penetration with the customers they already have.
How big is that opportunity, the media services within the existing base?
They estimate those customers spend close to $1 billion a year on relevant media campaigns. And Veritone's share of that wallet right now, less than 5%.
Wow, okay, so huge room for growth just by selling more to existing clients.
Exactly. And they said they are having success doing that, increasing that share.
And the Workday partnership. That sounds significant. Yeah, becoming a Workday certified platinum partner. That opens doors for co-selling. They said even though it started mid-quarter, they're already seeing it bring in new clients, expecting meaningful growth from that channel.
So overall picture for Hire, stabilizing maybe, after some rough patches.
Management seems to feel it's reached stability compared to the last couple of years. They're forecasting modest to flat growth for the full year, FY25. But they do expect a return to growth late 25 or into 26, assuming the job market conditions cooperate.
Okay, now public sector. This sounded like a really bright spot. IDMS, their evidence management system, gaining real traction.
Absolutely. Seems like it. They're working with hundreds of local law enforcement agencies now, using IDMS for investigations, public records, FOIA requests, redaction, critical stuff.
And expanding.
Yeah, adding technical partners, integrations, leading to new sales ops weekly. And because IDMS is a suite of applications, it's apparently helping increase average deal sizes too.
And we're talking bigger deals now, larger agencies, maybe states.
Yeah, it's like it. They said they're in final procurement stages with several large California counties. Also, major police departments and DA offices in big North American cities. And they're growing in Canada through a partnership there too.
Right, and the GTA partnership is moving along.
Yeah, moving to the operational stage now, working with joint customers.
What about the U.S. federal side? That's always a big target.
Making strong progress there too, it seems. Veritone Investigate got awardable status on the TradeWinds marketplace, makes it easier for federal agencies to buy.
Okay.
They're doing a proof of concept with the DoD on procurement fraud, working with the Defense Logistics Agency, the DLA, on a big contract called JET 2.0 for FOIA and investigative services.
And deploying on secure systems.
Critically, yes. They're deploying IDMS and aiWare on the DLA's private tenant. That's a huge validation, proving they can meet those really high DoD security standards.
Meeting those federal security bars must unlock a lot of potential.
You'd think so. And they're involved in Project Defender too, supporting DoD, DHS, DOJ agencies on border security, law enforcement modernization.
Big initiative.
Huge. Management expects significant budgets to get approved there, starting to generate revenue in FY26. They see Veritone playing a key role.
Okay. So in Q1 specifically, they added 8 new state and local customers, 40 expansion deals within existing ones. What does the overall public sector pipeline look like now?
Big number. Exceeds $110 million. Shows that demand for AI in government is really growing.
And that's mostly expansion.
Yeah, they highlighted that the majority is expansion within existing agencies, which usually means a higher probability of closing, right? You already have the relationship.
That makes sense. And these are big deals.
Sounds like it. Many are high 7-figure to mid 8-figure deals, duration 1 to 5 years, and importantly, they're in near-term contract phases.
And if these contracts land, they're ready to go.
That's what they said. For some of the big ones, especially DoD-related, they're ready to deploy the software immediately once the ink is dry. Mentioned AWS deployments being ready.
What kind of growth are they targeting for public sector this fiscal year? It sounded aggressive.
Very aggressive. 100% to 150% revenue growth in fiscal 25. That's the target.
Wow.
They see that starting to ramp up in Q2, but heavily weighted towards the second half of the year.
Okay, quick look at the balance sheet and liquidity. How are they fixed for cash?
End of March, they had cash and restricted cash of $16.4 million, down just slightly from $17.3 million at year-end 24.
There was an operating cash outflow in Q1.
Right, about $17 million outflow from operations, partly working capital timing, but that was pretty much offset by inflows from investing and financing activities. Around $16.5 million came in.
Mostly from that share offering they did.
Yeah, the registered direct offering. Sold 4.4 million shares at 2.53 cents, plus 3.6 million warrants at 2.52 cents. Gross proceeds were $20.3 million.
And they've been chipping away at debt too, haven't they?
They have, yeah. Consolidated debt is down to around $130 million now. That's way down from the peak of $201 million back in late 2021.
What makes up that $130 million?
It's about $39 million in term debt due late 2027 and $91.3 million in convertible debt due November 2026.
Do they have other ways to access capital if needed?
Yes, they mentioned having over $30 million still available under their $35 million ATM facility, and they also said they're in talks to potentially improve the cash position further.
Okay. And share count, end of Q1, was 44.9 million shares outstanding, plus about 2.5 million warrants held by debt holders. All right, let's wrap this up with the outlook. Guidance for Q2 and the full year. Management sounds pretty optimistic long-term.
Yeah, they said the software pipeline and long-term outlook are at all-time highs. For Q2 specifically, they expect revenue between $23 million and $25 million.
How does that compare to last year's Q2?
Q2 24 was $24.1 million. So the midpoint of the guidance is roughly flat year over year.
And the segment breakdown for Q2?
They expect public sector to be up year over year, driven by those DoD projects starting. Commercial enterprise, roughly flat overall. They see about $1 million decline from consumption and higher managed services being offset by about $1 million growth in commercial SaaS, mostly VDR.
And managed services.
Down year over year, continuing that trend from the representation business slowdown.
What about Q2 profitability?
Yeah.
Margins, net loss.
Q2 non-GAAP gross margins expected a bit better than Q1, somewhere between 68% and 70%. And the Q2 non-GAAP net loss is projected between $8 million and $9 million. That would be an improvement from Q1 24's $9.7 million loss.
Okay. Now, the full year 2025 guidance got an update, right? Or revision?
It did. Full year revenue guidance is now $104 million to $115 million.
Okay. What's the midpoint there?
Midpoint's $109.5 million, which still represents an 18% increase over FY24 revenue. So still solid growth expected for the year.
And the full year non-GAAP net loss guidance?
Projected between $20 million and $30 million. Midpoint of $25 million. That's a pretty significant 39% improvement compared to last year's non-GAAP net loss.
What was the main reason they gave for tweaking the full year outlook now?
Primarily timing again, shifting some of the expected impact from those big growth drivers, public sector and VDR, more into the second half of 2025.
Ah, okay.
It also factors in that continued slowdown in managed services and the VDR margins being a bit lower in the first half than maybe previously thought, though they expect those margins to improve in H2.
So the whole story really hinges on a major acceleration in the back half of the year to hit those numbers.
Absolutely. That's the core narrative. They specifically said they expect H2 revenue to be up somewhere in the mid-30s% range compared to H1 revenue.
Mid-30s jump H1 to H2.
Yeah. Fueled mainly by, 1, VDR getting faster, and 2, the timing and execution on those big public sector deals. The key bets for FY25 remain that huge 150% public sector growth target, very H2 weighted, and commercial enterprise growth coming from core renewals, but especially VDR kicking in. They expect $5 to $10 million from VDR this year, plus leveraging those AI and cloud partnerships.
Okay, so stepping back, thinking about this from an investor's viewpoint, the call really paints a picture of Veritone in the middle of a big strategic shift, doesn't it?
Definitely. It highlights them actively trying to move away from some of those lower margin, maybe declining legacy bits towards these potentially higher growth, higher margin areas. VDR and public sector AI are clearly the focus, trying to offset headwinds elsewhere.
And that VDR opportunity, I mean, it seems custom built for the current AI moment, right?
Yeah.
Addressing that massive need for training data.
It does. And what's interesting is how Veritone seems positioned to use their existing media processing tech and relationships. It's not starting from scratch. That rapid doubling of the pipeline you mentioned is a really potent signal that sophisticated buyers like the hyperscalers are engaging seriously.
And on the public sector side, that $110 million pipeline, the specific projects like Project Defender, DLA, it suggests potential for chunky multi-year contracts. Maybe more predictable revenue, even if it comes in lumps.
Yeah, and that aggressive 150% growth target for public sector this year really underscores management's confidence. It's not just aspirational. They seem to feel they have line of sight to deals that make that possible. The partnerships, too, Workday for Hire, hyperscalers, and GTA for public sector VDR all seem aimed at speeding things up and getting bigger bites.
So, yes, there's near-term weakness, Q1 softness, margin pressure in H1. Those are the headwinds. But the story they're pushing is clearly all about a significant ramp-up starting the second half of this year.
Exactly. And meanwhile, they're managing the balance sheet, the equity raise, paying down debt, trying to make sure they have the fuel to fund that growth while keeping an eye on those debt maturities down the road. Execution in H2 is everything now.
Okay, let's pivot to our "this is not financial advice" segment. You've heard the setup directly from the call. Q1 took a hit from timing delays, sure, but management is really laying out a case for a potentially huge second half acceleration.
Yeah.
VDR deals, big public sector contracts landing. That projected jump in revenue from H1 to H2 is substantial in the mid-30% range, but it all rests on execution. So here's an outrageous but plausible idea for you listeners out there who like a bit more adventure. Think about Q4 2025 call options.
Right. Now, the outrageous part here is pretty clear. It's a massive bet on timing and magnitude working out perfectly.
Yeah.
You're basically banking on those multi-million-dollar VDR deals converting smoothly and key parts of that huge public sector pipeline turning into actual revenue, specifically in Q3 and Q4, to push them towards the high end of that $104 to $115 million guidance. If execution slips, if deals get delayed further, those options could easily expire worthless. Big risk.
But here's the plausible angle. Management didn't just sound hopeful. They sounded genuinely confident on the call. They talked about high visibility on the size of these deals, especially in public sector expansion where they know the terrain. They pointed to the rapid conversion they're already seeing in the VDR pipeline with very sophisticated buyers. The hyperscalers aren't just kicking tires.
And they've already proven they can deploy on secure federal systems like with DLA. That does de-risk the technical execution piece somewhat.
Exactly. So they claim to be tracking real deal dynamics, deployment readiness, things that make them believe this aggressive H2 ramp is achievable. It's definitely high risk, high reward. A direct bet on management delivering on speed and execution for these specific, large, identified opportunities in the next 6 months.
And we have to stress again, trading options is inherently risky, not for everyone. This is just an idea sparked by the narrative on the earnings call. Purely illustrative.
Absolutely. Okay, that wraps up our deep dive into the Veritone Q1 2025 earnings call.
Yeah, key takeaways. Q1 had some expected bumps and timing issues, but the focus and the guidance are all pointing towards a potentially very different story in the second half, driven by VDR momentum and those big public sector contracts they expect to land. Plus, they're actively managing the balance sheet and using partnerships to fuel it.
And remember, everything we talked about today is based purely on the earnings call information. It is absolutely not financial advice. Please do your own research and talk to a professional before making any investment decisions.
That's right. You can find the full transcript and investor materials on Veritone's IR website if you want to dig deeper into the source yourself.
So one final thought for you to chew on. Management is betting heavily that the Q1 timing delays were just that, delays, and that they'll be followed by significant growth kicking in soon, powered by VDR and public sector. The big question to watch over the next 6 months is just how much of that confidence translates into actual tangible revenue execution.